The money market is a market of debt instruments that have short-term maturities, meaning less than a year. They exist to allow governments and banks and large institutions to raise money by selling these money market securities to investors. It also allows investors, which consist of individuals as well as large institutions, to invest their excess cash in a very low-risk way and earn some interest. Let's look at how the money market actually works. Large corporations that need cash flow can borrow money by selling these securities, or corporations with excess cash can be the investors as well. Small companies can invest through mutual funds or through their bank, and individual investors can invest in money market through their bank account or through a mutual fund as well. Let's look at the type of securities that these investors can issue or invest in. The governments issue treasury bills. Banks issue certificates of deposit. Corporations issue commercial paper. Banks can also create short-term mortgage-backed securities. And banks also issue a product called a banker's acceptance that's guaranteed by their own bank. And finally, there are repurchase agreements, which are short forms of borrowing that involve selling a security with an agreed upon price that it will be repurchased at in the future. Let's look at the function of the money market. It helps contribute to economic stability and development by providing liquidity into markets and into institutions. It helps with trade financing. It helps with central bank policy management. It helps with the growth of corporations and industries by allowing investment to flow through. And finally, it provides commercial banks with a market that they can directly invest in when they have excess reserves, or that they can borrow from if they need additional liquidity. Thank you for joining us for this quick tutorial on the money market.